Hi there, Llanes here with Wealthnet Investments. Today I'm going to be talking about the anatomy of a winning stock. And I've got some notes here. What we've done is we've put together some examples for you to kind of look at what does a good stock look like? What are the kind of stocks that we're targeting? What are the kind of companies and what are their characteristics before they launch into new high territory, when they start doing well? And how can we actually capture trends in these companies? And so what I'm going to do is I'm going to dissect one company just to talk about the main bullet points of the things that we look for, and then kind of break down into some of the quantitative price trends and what that looks like. But the first thing that we're going to want to do is we're going to want to kind of take a look at the fundamentals first, because when we're looking at these companies, we're not only are we looking for good, strong trends in the price, but we're also looking for certain characteristics. And there's really some key points. We're looking for profitability. We're looking for growth. We're looking for financially healthy companies. We're looking for companies that have a strong niche. And we're also, last but not least, looking for strong quantitative price trends, and we trade them in a very disciplined way. So let me just dive in. I'm going to use an example here. And this example is of a company that I actually know fairly well because I actually used their product. And I thought this would be a prime example of the kind of company that we could actually participate in and what we're targeting. The company I'm going to use is a company called Align Technology. Align Technology, they make Invisalign. Now, you may or may not know this about me, but I had braces earlier in my career when I was in my late 20s, and basically I decided that I was going to let my dog eat my retainers. And I actually did that a couple times, and finally I just stopped going back and I stopped wearing my retainers. And the first time I went through the whole process, I had these expansive retainers. It was quite a process to get my teeth straight, and they looked great when they were first done. But it was a very, really painful process, and it took a long time. And then I decided later on, really actually like a year and a half ago, that I was going to go ahead and have them re-straightened because I stopped wearing my retainers. And over time, because I wasn't wearing those retainers at night, my teeth shifted again. So I went to my orthodontist, and she's absolutely great. And she said, hey, why don't you do Invisalign, because you're always doing presentations, you're in New York, you're in different places, and you could wear these and people can't really see them because they're very clear. And not only that, because of the technology that is used, we can align your teeth much faster and more precisely than kind of the old method. It costs quite a bit more. And I'm like, well, that's okay. I think that makes a whole lot of sense. So we did it. And literally, even in time before it was supposed to have been done, my teeth were aligned, and now I wear my retainers at night. So Invisalign had a really great product, and so that's why I wanted to use this, because that company actually fits all of the criteria of what we're targeting. So let's just dive in here. I want to kind of look at this chart here. There's a lot of numbers here and some arrows and stuff, and I want to just walk you through the anatomy of a winning stock and what it looks like. So if you look over here on the left-hand side of this chart, back in 2009, the company was losing money, right? The company lost $31 million. They had only 300 million in sales. It was still, or 30 million in sales. It's still decent. The company was doing fairly well. But notice what was happening with the stock at that same time. If you look right here, the stock was actually hitting new highs, even though the company was losing money. So the moral of that story is that you can have some stocks that are great purchases even when they're losing money, but they're on pace and they're growing their revenue really fast to start making money. So they're kind of crossing that chasm from being a losing company in terms of profitability into a winning company, because our first criteria that we're looking for is profitability. Now, we're looking for them to actually have a path to that profitability. And you can see what happened here. The stock actually took a little bit of a correction in 2010, actually, as the company went public. They actually went positive. You can see this here. They made $74 million. And the company was in a kind of a corrective mode, and it started basing and then started much higher. Now, this is a very long long time frame. So you have to understand the scale here. We're talking about some big moves that are occurring here. So we saw this move start heading higher as the company went public. And again, we saw that profitability, and what we literally saw was a massive growth pattern. We saw the company go from $74 million till in 2018, $400 million. So we saw, if you look at this area up here, I kind of calculated from in the 8 years from 2010 to 2018, from when they first went profitable, the net income went up 439%. Big compound. Revenue went up 405%. So we saw, we want to see top line growth. We want to see new products and new services in high demand. And I'm going to get to a point on that, which is the niche area, the niche criteria that we really are looking for. So that's the second part of it. So the first is profitability. We see that happening here, switching in from 2009 and 2010. And by the way, we will take a position sometimes as a company is growing where we think they're at that cusp of going profitable. They're not quite yet profitable, but they're at the cusp. And we may also take a position if the stock actually, because of the way they do their accounting, they really are making free cash flow, but it's not showing up in the numbers. Okay, so profitability, number one. Number two is growth. We talked about that. You could see this massive growth. So as the stock is progressing in real time, now we have the benefit of hindsight here. We're looking back in the past. But as the stock is progressing, we're going to want to see that progression happening with the actual numbers. We're going to want to see revenue increases. We're going to want to see margin expansion. We're going to want to see profitability expansion. So that's it. So profitability, number one. Number two is growth. Number three is financial health. Now, before I move on to financial health, there's one key thing that I do want to point out, because you often hear me talk about quality and value and technical. Now, with our dynamic growth strategy, which is what I'm talking about today, we're not focusing as much on valuation because these companies are growing so fast. Oftentimes, the valuation metrics are not going to be the traditionally low valued, low multiple type companies. In fact, if you look at this particular stock, and we can go through many examples, but just to look at this example, notice what was happening. The stock was trading at above market valuations. It was trading at almost 34 times earnings. As the stock was moving higher, it got up to as high as 150 times earnings, and the company was still doing very, very well. This is a characteristic of some of the best companies that you have from a growth perspective. They will go to these higher multiples. So you're not really using valuation as much in this particular our dynamic growth strategy as much as we're using in our fundamental core strategy, where we're actually putting more emphasis on valuation, more mature companies that we're focusing in on the fundamental core. But in this strategy that I'm focusing on today, in our dynamic growth strategy, we're really not looking for that. We're less emphasizing those value factors. That's a key point I wanted to kind of talk about. Now, the fourth criteria that we're always looking for is niche. So there has to be some kind of a niche. That's our preference. Sometimes it could be just a change of some sort happening in the company, but some of the best winners have just had a really amazing niche. So in this example, Align had a niche. They were the first mover in this clear Align market. They had morphed the company into a global orthodontics powerhouse, and they really monopolized the market. And obviously, they have patents and ways to protect their property, and that gives a solid niche. Now, the other thing I want to really point out is that they successfully proved that they are more efficient in what they're doing, right? So that adds to that niche, that they have a better way, a better mousetrap, if you will. And they've actually created a category, like you think about, I don't know, there's lots of examples, but in their case, when you say Invisalign, that brand itself is synonymous with that whole category of clear alignment technology for the teeth. So this is the kind of thing that we're looking for as an example. Financial health. So in the financial health area, look at Align's balance sheet. What I did was I just wanted to show you their balance sheet on a what's called common size, where we basically take all the accounts on the balance sheet and we make them as a percentage of the total assets of the balance sheet. And that can give you an idea about the structure of their balance sheet. And if you look here, first and foremost, we're looking for a few things. Number one, good cash liquidity. Here you could see the company back in 2009 had 52% of their assets in cash. Today they have 35%, so that's not as good, but it's still very strong. Very few companies have that much cash on the balance sheet as a percentage of their total assets. Plenty of liquidity in this company. And then also the other thing we want to see is we don't want to see a whole lot of debt. If we look at the total liability line, the company started off with only 23% of its assets in liabilities and money they owed. So that has since gone up to like 38%, but still very healthy, good equity position. So strong cash liquidity, low debt. And lastly, good cash flow. So if we go and we look here, we could see that the cash flow on this particular company was increasing, and it's free cash flow to equity. So there's a way to back into that, but basically we want to see that the shareholders at the end of the day are earning cash, because earnings is a funny thing. There's a bunch of accruals and stuff in there, and it doesn't necessarily show cash. And what we really care about as an investor is cash in hand. As my first economics professor used to say, the green in the genes. So I'll never forget that. So that's really what we're looking at when it comes to the fundamental side. And I'm really just showing you this on a high level. Now when I want to talk about the last criteria, which is the most important in terms of how we trade it. Not in terms of what we do. It does help us in terms of picking out where to go, but it also, more importantly, helps us manage those that we decide that we're going to invest in. So that category is strong quantitative price trends. So now what I'm going to do is I'm going to back up and I'm going to actually show some charts, because I think it's really important to visually see what we're talking about when we're dealing with price trends. This here is a chart of a line, and you could see this going back to 2014. And this is a linear chart, so it's not semi-log. So you don't see as much as the percent changes you see, but this basically gives you a feel for what happened. The stock really went, way, way up. It went from 50 all the way up to 390. So when we're trading these stocks, we look for quantitative price trends, and we have indicators that help us understand when a company is showing tendencies for trending higher, and those include breakouts to the upside, volatility range expansion type indicators, and that really helps us to be able to see those companies that are moving forward. And so if you look at these top lines here, you can see those are breakout type bands and so range expansion type indicators, and all along the way the company is moving higher. And we also are, more importantly, we are also looking to manage risk. The biggest winners, they will tend to stay towards the top end of the bands, and they will not move down to our risk parameters. This line below is a level where we say, hey, we're just going to either initially stop out, or the level where we're going to take our profit. And you can see we had this long period of time in this particular stock that moved above that line and then comes down. And there's very large gains in there. At some point you have to take the money off the table. There's a couple different things. One is when you're managing a trade is you want to take the long-term trend, and then the other has to do with profit taking. If a company moves up very, very quickly in a short period of time, and we have parameters for that, oftentimes it makes sense to pull some of your capital off of that stock because the probabilities of the stock moving higher is lower. And we have statistics on this where we're looking at the daily volatility of a company, and if it moves up a certain multiple of daily volatility very quickly in a certain period of time, the probabilities historically, if you look at data, thousands and thousands of pieces of data, statistically, most companies tend to not go much further higher, and it makes sense to take some of the money off the table. But we don't want to take all the money off of the table at that time, because we want to let our profits run. So rule number one on how we trade is there's some critical trading techniques. Number one is size the positions appropriately, right? Rule number two is, and I can get into that maybe on another video. And then another is is you want to let your winners run, and then you want to cut your losers short. So we get an asymmetric rate of return profile for the companies that we're trading. So and you definitely want to diversify. That's the other part of it. There's a whole thing we can talk about portfolio construction, but today we're talking about the anatomy of a winning stock. So here's just to summarize what's going on is you have profitability, you have growing profits, we have financial health, we have a niche in the product or service or some change that's happening with a company that's mixing up that's improving the prospects, and we have strong quantitative price trends, and then lastly we have critical trading techniques that we do, trying to get an asymmetric return by cutting losses, by letting winners run, by taking profit taking but never letting the stock completely off, as long as the fundamental criteria is still there and as long as the trends are still in place. So that's just a general overview. Now, one thing I can do before I sign off here is just kind of punch up a couple of other stocks. There's other companies that we can look at as examples. One would be Booking. Another company that, has trended higher, much more choppy, but still trending higher. Notice we give the stock lots of room, gets out, then gets back in. That's another important thing about this. It's okay to get back into a stock. In fact, you should get back into a stock if you get out of it and take a loss, but the fundamental criteria is still there, and then the price trends resume higher, get back into the stock. That's a big part of the discipline. If they meet the criteria and the trends are there, get back in. Don't be afraid to get back in a company. And some stocks we get back in many times more than once. So let's look at another couple examples. I remember, you may remember this too, but Microsoft. Microsoft was dead money for a long time. In fact, after the financial crisis, or not the financial crisis, but the dot-com bubble, we went through a period of malaise in Microsoft that was unprecedented. And then we came back into an uptrend, and look at this uptrend, stock hitting new highs, breaking out on volatility expansions, range expansions, and seeing that our trailing stop moving higher and higher. These are the kinds of things that we want to do with managing a stock portfolio. Let's do one more. Here's one that probably a lot of people haven't even thought about. Sometimes it could be a company that doesn't sound so sexy but has some great things going on. This is Autozone. Right now, in fact, we're seeing lots of breakouts happening with artificial intelligence, with companies that are involved with supplying automobile manufacturing, because the automobile manufacturing automobile industry is about to have a massive change, and all the new technologies is going to change how we drive. Where the cars are more automated, where there's more technology inside the car, and there's money to be made in those companies. Clearly, some of those companies and many of those companies aren't making money. Some of them are, but it's a small part of their business. So, but there's always new things happening, and that's what we want to scour the markets for. And what's interesting about that, technical analysis can help us see that happening. We could see companies that are breaking out, and it's like, well, why is this company breaking out? And it's a relatively unknown company. And maybe they're losing money, but their revenue line is increasing dramatically. Lately, I noticed that we've been seeing some solar companies that have been breaking out. Lots of them don't make money, and there's interest there. It may or may not turn into something that's real. What we're trying to do, and sometimes we're going to get into things that wind up not being real, but because of our discipline, we're going to be able to get out, and that's our objective, is to get out of those when they're not working. In fact, the strategy's win rate is really between 40 and 50%. You don't have to be right 90% of the time. In fact, it's that you don't want to be, because those tend to be systems that blow up. So trading strategies that are more robust, that can stand the test of time, tend to have lower win rates, 40 to 50%. And but you have asymmetry between your average win and your average loss. So your average win may be 3, 4, 5 times your average loss, or even more. Some trades might wind up being 30 times your risk. So this is the kind of thing that we're looking for. All right, well, I think that's enough about this topic. One more summary here: anatomy of a winning stock, profitable companies, growing companies, financially healthy. They have a strong niche, strong quantitative price trends, and you trade them using the critical trading rules, sizing properly, cutting winners, letting your profits letting your profits run for the most part, taking money off when you have very fast acceleration that is beyond what the normal statistical evidence shows that should do in the short run. All right, this is Llanes with Wealthnet Investments signing off. Follow me on Twitter if you want to, comment here and there on what's going on in the markets. If you want to learn more about what we do, go to our website, www.wealthnetinvest.com. And, you could always talk to us. You could request a meeting, and then we can have a phone call or an in-person. Thank you so much for watching. Llanes, Wealthnet Investments signing off for today. Have a good day.
The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals. If you like this information, be sure to subscribe and follow us on Twitter and Facebook.